The news comes in every evening. Bright red graphs slide up. Excited voices speak about record highs in the stock market. It all sounds like good news. It feels like everyone is getting rich. Big numbers flash on the screen. Words like growth and profit fill the air. But many families don't feel richer at all. Some still can't pay their bills. Others never got their jobs back after the Great Recession. This might sound strange. Isn't the economy supposed to be doing great? If the stock market is growing fast, why are things still hard for many people? Why do wages stay low while stocks go high? This can feel unfair to many. It leaves us with a big question. What does the stock market really tell us? Does it show how life is for normal people, or only for a few rich ones? People want answers because they see a big difference between what the news says and what they feel in their daily lives. It doesn't always add up. In this book, we are going to take a closer look at the stock market, what it is, how it works, and how it affects the lives of everyday people like you. We will ask why things sometimes feel so mixed up. How can things look so great in business reports, while families struggle to buy food or pay rent? This chapter starts the journey. The truth about money, markets, and people may surprise you. Sometimes the biggest numbers hide the saddest truths. In Chapter 1, we looked at the world of big numbers and how they don't always match real life. Now, we ask a deeper question. What is the stock market exactly? Let's think about a small business. Jill sells lemonade in her town. Her stand is popular, but to grow bigger, she needs more money than she has right now. Jill asks the bank for a loan, but they say no. So, she finds another way. She can sell small parts of her business to people. These are called shares. When she sells shares, anyone can buy a piece of her lemonade stand. This is called going public, and the first sale is called an IPO, or initial public offering. Each share might cost $1. If Jill sells 100 shares, she now has $100 to build more stands or try new things. She uses the money to grow the business. Buyers hope that Jill's business will do well. If it does, they can sell their shares later to someone else for more money. This is how people make a profit. Let's say Sam missed the IPO, but he still wants a share. He asks someone who bought it before and offers $2. That person agrees and sells it to him. Now, the value of that share has gone up from $1 to $2. If more people want shares, the price can go even higher. If fewer people want them, prices go down. Just like this, the stock market works by people buying and selling shares. Prices go up and down depending on what people believe will happen next. In real life, this buying and selling happens very fast. Thousands of trades happen every second. Around the world, people are trading shares all day long. Some people want to sell because they need cash. Others think a company will grow, so they buy. These choices help decide the share prices each day. This might sound like a lot, but remember Jill's lemonade stand. It all starts from a simple idea. Share a business with others and grow with their help. After learning how shares work, it's time to look at where they are bought and sold. These places are called stock exchanges, like NYSE and NASDAQ. The New York Stock Exchange, or NYSE, started in 1792. It is where people trade shares of big, old companies like IBM. It is a real building in New York City. The NASDAQ is newer. It began in 1971 and is used for trading tech companies like Apple or Facebook. It is different because it works only by computers. To know how well stock exchanges are doing, we use something called indexes. These give one number to show how many companies are doing overall. The S&P 500 is one big index. It looks at 500 of the biggest companies in both NYSE and NASDAQ. It changes every day as company share prices go up or down. The Dow Jones is another index. It checks 30 important companies. If those companies do well, the Dow goes up. If they do badly, the Dow goes down. Many people now invest their money in something called an index fund. This puts small amounts of money into many companies at the same time. An index fund is easy to use and safer than buying only one share. If one company fails, the others can still do well. It spreads the risk for the investors. Some people pay experts to buy and sell for them. These experts try to make more money. But many studies show index funds often make more in the long run. One famous investor is Warren Buffett. He became rich by choosing good companies to invest in. He believes in a style called value investing. Value investing means looking at a company's health, not just guessing if the price will go up. Buffett chooses companies that do well for many years. Buffett says most people should use index funds. He even bet a lot of money that index funds would beat top investor groups. And he won that bet. Now that we know where shares are traded, we can look at some good things the stock market can do. It's not just numbers, it can also help people in real life. When businesses sell shares, they get money. This money helps them grow faster, open new stores, or try new ideas. This can lead to more jobs and more products. A small shop might grow into a large company with stock help. That company may hire hundreds of people and bring new tools or machines to the market. In the past, public companies like General Motors used stock money to build cars and create jobs. These jobs helped every part of the country grow stronger. Many of these businesses also made products used in daily life: phones, light bulbs, and paper. Stock sales helped companies like GE build these for everyone. With more workers, more stores, and more things being made, towns across America had better schools, roads, and homes. Life improved for many people. These growing companies paid workers well, gave good health plans, and helped families buy homes. These jobs were the start of the American middle class. The middle class is a group between rich and poor. Stock growth helped many people in this group live better by giving them stable jobs and good pay. Not only rich people had a chance to grow wealth. Normal families joined in and shared companies' success. The stock market gave them that chance. The idea was simple. People work, companies grow, shares rise, and everyone wins. This was a time when stock market growth helped many, not just a few. This system made companies care about workers, buyers, and their towns. They worked to build things that lasted instead of just making fast money. Some leaders saw their company as a tool to serve people, not just to make cash. They wanted to be trusted by not only investors but also the public. So far, we've seen how the stock market can help people and companies. But now, let's talk about something else. How stories and beliefs can also move prices. A famous thinker, John Maynard Keynes, had an idea. He said that buying stocks is like a face contest. People choose based on what others will choose, not what they really think. This means stock prices can rise or fall just because people believe something, not because of real company facts. This kind of thinking can be risky for everyone. Sometimes stories that move the market are true. When bad things happen, such as car problems at Volkswagen, people sell their shares and prices drop fast. Other times, the story is full of hope but without strong facts. This happened in the 90s during the dot-com boom. Internet companies had high prices, but many failed later. When people follow big stories that are not based in truth, this can create what is called a bubble. In a bubble, prices rise too high and they must fall one day. When a bubble ends, it pops. This means the prices fall very fast. Many people lose their money, jobs are lost, and it can hurt the whole economy badly. Companies may close, retirement savings may shrink, and families feel the pain. This happened after the dot-com crash and in the Great Recession as well. Even when the market rises too fast with no real reason, it can be harmful. It causes fear when people know prices will fall, but they don't know when. In the last chapter, we saw how stories can change the market. Now we look at a new idea that changed companies, making shareholders the most important. This idea came from a man named Milton Friedman. In 1970, he said that the only job of a company was to make money for its owners, the shareholders. For many years before that, companies tried to help workers, towns, and buyers. But after Friedman's idea, things started to move in a new direction. Company leaders, called CEOs, started to care more about stock prices. They wanted to keep shareholders happy, even if it hurt workers or the company long-term. One tool they used was called a buyback. The company uses cash to buy its own shares. This makes fewer shares in the market, and the price goes up. While price looks better, the company does not grow stronger. It just looks richer. This helps share prices rise fast, but it may not help real business success. To keep prices growing, CEOs also started to lower costs. Many stopped giving raises. Some cut jobs or closed work sites to save more money quickly. These cuts can make the company look good on paper, but they can harm workers, towns, and the economy. It helps the few, but hurts the many. Workers may lose their homes or health care. Towns with fewer jobs may lose stores and schools. The company may save money, but people suffer. One clear example is Warsaw Paper. It had many workers in a small town. The company wanted to change its product to make tissue paper instead of writing paper. A group that owned shares said no. They wanted faster money. They pushed for the company to send cash to them instead of buying new tools or training. The company gave in. It closed the factory and 450 workers lost their jobs. The town, Brokaw, lost income and hope. It showed the cost of short-term thinking. The CEO and board of Warsaw believed in the long-term plan. But because of shareholder pressure, they were forced to make fast money choices instead. They even offered to take less pay to keep the factory open. But the group that wanted more dividends did not agree. They cared only about price. This is not just one story. It happens in many places. A quick rise in stock price may look good, but the real cost can last for years. Chapter 6 showed how companies started to care more about fast profits. But who is really winning from this? Let's look at what has changed and for whom. Years ago, CEOs earned more than workers, but the gap was small. Today, that gap has grown very large. Some CEOs now earn over 200 times more than the average worker. Even when a company does badly, many top bosses still get big bonuses. They are often paid more in shares, so they care more about share price than real growth. As stock prices rise, you might think more people are getting rich. But fewer Americans are now investing in stocks. Only a small group holds most of the shares. In the past, many middle-class families had small investments. They hoped to grow savings for things like college or retirement. Now, many have left the market. This means when the market goes up, it helps mostly the rich. Normal families who are not in the market do not get that money. The system grows more unfair. Why have people left the stock market? For some, it feels too risky. Wages have stayed low and they need their money now to buy food or pay for housing. Others saw their savings drop during market crashes. It made them afraid to invest again. The market may rise, but it doesn't feel safe to many families. At the same time, people who already have more money can take these risks. They invest more and grow richer. This gap is making people feel left out. Short-term thinking also harms the company's health. When businesses cut costs to make fast money, they don't invest in tools or workers for the future. This can stop new ideas and slow down growth over time. A company might look good now, but later it may fall behind because it did not prepare well. Helping workers learn more or buy better machines can help both the company and the people. But many skip this to keep profits high for just a short time. The people at the top often say that if stock prices go up, it means success. But they forget that price does not always match health or growth of a company. Some leaders know this too. They want to make good changes but feel pressure to keep prices high. If they don't, loud investors may try to replace them. In the race to please shareholders, we forget workers and towns. When companies stop caring for these, the middle class begins to disappear slowly. In Chapter 7, we saw how money and power rose for a few people, while others were left out. But the story is not finished. Things can still change for the better. People who own company shares, called stockholders, have the power to speak up. They can ask companies to be fair, help workers, and not just chase fast profits. Stockholders can vote on company choices. They can ask for good care of nature, fair pay, or clean business rules. They are more than just silent money givers. Some people think making money is enough, but others want more. They want companies to make money in ways that also help people and the world around them. This means choosing ideas that are good for all, not just a few stockholders. These ideas may take longer, but they build stronger jobs and cleaner towns over time. Helping others doesn't hurt profits. In fact, caring about people can keep workers happy and stay with the company. This helps the company grow long-term. New kinds of funds now look for companies with good values. These are called ethical or moral funds. They choose businesses that do not harm people or places. These ethical funds avoid companies that hurt animals, break nature, or use unfair rules for workers. They want companies to treat everyone with care. Your money can follow your heart. You can grow savings in a way that also helps others. Investing with values is good for your pocket and for our world. Many people now ask companies to share more information. This includes how they treat their workers, how they care for nature, and how they handle problems. Some companies listen. They share reports that show they are thinking about people, safety, and planet health. These companies earn trust and keep customers. Giving clear facts builds stronger trust. Workers feel safer, and buyers want to spend more. In the end, open and fair action can lead to true success for all. This better way isn't just an idea, it's already happening. Some leaders now care about more than just price. They think about their teams and local towns too. A company that gives workers respect and steady jobs can grow strong. Helping schools or cleaning rivers means giving back, and people notice that goodness. When we choose to invest in good companies, we help shape the future. Stocks can be more than numbers. They can show what kind of world we want to live in.